SpaceX's SEC Form S-1 filing just revealed something unsettling: a $41 billion accumulated deficit, which the total pile of losses the company has racked up since it started. But that was nothing compared to what happened toward the profit which is generated by SpaceX's manufacturing labor force through a Starlink constellation subscription revenue that is now being converted into NVIDIA compute clusters for an AI segment that lost $6 billion on its own in 2025. Imagine your company take the profit from your job, but instead of putting it toward your benefit, they spend all of the money to buy a warehouses full of NVIDIA compute clusters, which is an expensive AI chatbot called Grok that might replace your job. But it just got worse. Earlier this year, SpaceX merged with Elon Musk's separate AI company called xAI, which they share the capital expenditures with, one balance sheet that also covers employee compensation structures, meaning that your paycheck and Grok's chip bill now come out of the same pot. Two businesses that used to be separate are now sharing one wallet, while the other one just lost $6 billion last year on its own. Surprisingly, right before they selling the stock on the SPCX NASDAQ listing, SpaceX basically tell the investors that the AI bet is worth the risk. But nobody's told you what happens if it isn't. Eventually, the consequences come almost immediately. Nobody has no idea what was going to happen for the next 13 months because the ripple effect just keeps getting worse, with each step is going to be worse than the last. The first domino happened on March 28, 2025. X Holdings, which a company that operates the social media platform formerly known as Twitter, was absorbed by xAI. What makes the situation alarming is that the xAI, now filled with a social media company's data, audience, and its infrastructure. The official filing notes that X had over 1.3 billion supported active accounts for the last 12 months, and the entire user base has become the training data for Grok, which the AI chatbot that xAI was developing. Every single posts, replies, and the behavioral patterns of hundreds of millions of people were fed into a learning machine pipeline that now sits on SpaceX's balance sheet, which should have been in completely different acquisition. If you posted something on Twitter for the last 2 years, your data may have helped to train the chatbot that currently lives inside the same company that building an orbital rockets. To make things even worse, on February 2nd, 2026, SpaceX then acquired xAI in an all-stock reverse triangular merger. The S-1 filing even confirms that both transactions were carefully designed as entities under common control, meaning that the books were merged as if the three companies had originally been as one company. Therefore, the financial statements were rewritten, which the past was adjusted to match the present. If you were reading the 2024 numbers in the S-1 filing and not seeing the SpaceX of 2024, that's because you're seeing a reconstructed entity that includes Twitter's data and xAI's losses, which presented as if those businesses had existed there from the start. Surprisingly, this retrospective recasting isn't illegal. It's a standard accounting for a merger between businesses that already controlled by the same owner. But it should have changes the way how you should actually read the filing. The revenue growth will look a lot smoother than it actually was because the loss patterns are also blended across the multiple businesses instead of standing alone. That's make a company that launched a rockets is being reported as if it had always been an AI and social media conglomerate. Because of the historical baseline is shifted, and the shift is mostly benefits its narrative. A beginner investor that flipping through the S-1 filing would see a continuous growth curve and might never realize that the curve was stitched together from three separate businesses. Surprisingly, the prospectus doesn't even try to be subtle about this. It simply places the explanation on the page 74 after the mission statement and the rocket photography. Basically, the exchange ratio for each company is exactly 1 share of xAI converted into 0.1433 shares of SpaceX. Keep in mind that the precision matters because it means that the shareholder who once owned 1,000 shares of xAI will woke up with roughly 143 SpaceX shares locked into a valuation they didn't set and a balance sheet they didn't choose. The ratio was set by negotiation and not by the market price because xAI was private. There was no public market to argue otherwise. The shareholder simply had to accept the terms or walk away with nothing. If you are new to investing, this is a critical distinction because when you buy the SpaceX stock on NASDAQ, you're buying into a valuation that was negotiated in private room and not discovered in public markets. Therefore, observe that valuation staircase carefully because in late 2024, an employee share purchase program priced SpaceX at roughly $350 billion. By December 2025, a secondary tender pushed that number to about $800 billion. But then, in February 2026 merger, the combined entity was valued near $1 trillion. Eventually, by the June 2026 IPO, the target was $1.8 trillion. The number was tripled in just 18 months, while the rocket count didn't. Although the subscriber count grew, but not at a pace that explains that tripling, meaning that the AI segment is losing money in every period disclosed. The staircase was made of expectations and not by any output. Each step was funded by the next investor willing to pay a higher price, but not necessary by a corresponding jump in profitability or cash flow. But the staircase had an elevator, and not everyone had the ability to use it. Some ex-AI employees and executives were permitted to elect cash instead of stock during the merger, making them receive $75.46 per ex-AI share and walked away with a clean exit. Meanwhile, the rank-and-file SpaceX employees had no such option. Your equity was simply absorbed into a larger, more AI-exposed company, and the S-1 enforcement that shows no parallel cash election for you. One group had a door while the other didn't. If you look closely, the asymmetry here is disclosed in the filing itself, but it's buried in the compensation tables and the related party transaction notes. The merger was reportedly structured to qualify as a tax-free reorganization. That's a specific legal classification which allows the entities to combine without triggering immediate tax consequences at the corporate level. Think about that for a moment. Notice the contrast here, that the corporation received a carefully engineered tax structure, while the regular employees' restricted stock units get taxed as regular income the moment they vest. No such structuring is available to the worker on the assembly line because the tax code has a chapter for multi-billion-dollar mergers and a separate chapter for the payroll. The S-1 discloses both structures and it simply doesn't place them next to each other. Once the XAI's books became the SpaceX's books, the underlying concern became unavoidable. The revenue from Starlink subscriptions now flows into the same consolidated entity that funds Grok's training clusters, meaning that the profit from the manufacturing labor force now covers the losses from the AI segment. To make things worse, the S-1 doesn't answer that allocation in plain language. It answers it in segment tables, which in a way that will tell you a different story than the press release. In 2025, the connectivity segment, which is almost entirely Starlink, is generated $11.4 billion in revenue. That represents roughly 61% of SpaceX's total company revenue for that year. It produced $4.4 billion in operating profit and $7.2 billion in segment-adjusted earnings before interest, taxes, depreciation, and amortization. No other segment has came close to that. Meanwhile, the space segment, which covers the launch operations, just posted an operating losses, meaning the newly acquired AI segment posted a standalone operating loss of $6.36 billion in 2025, just for a $3.2 billion in revenue. Surprisingly, it is the only consistent profitable segment in the entire company, and at the same time, it was the sole reason why the consolidated balance sheet doesn't look worse than it already does. Starlink isn't a side project anymore at this point, because it became the financial engine to support the other company. To put that into perspective, by the end of 2025, the constellation had more than 9,600 active satellites, serving roughly 10.3 million subscribers across 164 countries. The average customer pays about $65 per month, and that's a recurring revenue, month after month, from the people who need internet access. It's the kind of business that typically gets valued on stable cash flows and predictable growth. because the telecom company with $11 billion in revenue and a steady subscriber growth would normally trade at a multiple based on those fundamentals. But inside SpaceX, that cash flow is being misused as venture capital for an AI experiment. These subscribers aren't investors. They're customers paying for a service, and yet their monthly fees are effectively to fund the compute clusters that have nothing to do with the internet satellite. But the transactions aren't really abstract at all. They describe it simply as a transfer. Basically, the Starlink customers pay monthly subscription fees, often around $65 per month for residential service, sometimes more for maritime or aviation accounts. That revenue flows into one balance sheet that funds warehouses full of NVIDIA GPUs. The filing shows that in the first 3 months of 2026 alone, the capital expenditures for the AI segment reached $7.7 billion. Meanwhile, the space segment only received $1.1 billion. The connectivity segment, which the one who earned the profit, received $1.3 billion. Basically, 3 out of every $4 of company-wide capital spending went toward AI infrastructure rather than rockets or satellites. The workers who build the dishes and all the satellites are generating the cash that buys the chips. If you're trying to understand what you'd own in SpaceX stock, this is the only ratio that matters. You aren't buying a rocket company. You're buying a telecom company that's being drained to build a data center empire. The physical connection runs deeper than just the accounting aspect, because the filing and accompanying coverage describe their plans for solar-powered orbital data centers. Think of it like this: the satellites and ground stations built by SpaceX's manufacturing labor force would become the physical infrastructure that hosting the AI models. The hardware that you build and assembled may literally power the automation that reduces the need of your labor. This is really unsettling, considering that the engineering plan revealed in the prospectus is undermined by the S1 risk section, which explicitly flags the orbital AI data centers as projects that might never turn a profit. The company admits that the idea might not work, even if they spend billions on the groundwork. Therefore, the risk disclosure is legally required, but it's also a confession dressed as a caveat. The S1 also notes that employees can elect to receive a portion of their base salary in restricted stock units instead of cash. That means a worker that's already living with tech industry wage stagnation can choose to take less money today in exchange for a paper ownership of the consolidated entity. Their compensation is tied to the stock, and the stock is tied to the financial statements, where 3/4 of new investment flows into the AI compute clusters. The loop just closed. You build the satellite to generates the subscription, and the subscription funds the GPU to trains its model, which eventually will automate and replace your job. But it just kept going downhill from there. As an employee, you own a slice of the whole cycle, but you can't really sell any of those yet. Consider a singular Colossus data center in Memphis, Tennessee, which houses more than 220,000 NVIDIA GPUs across over 300 megawatts of capacity. That's enough power to run a small city, and it's dedicated to computation. A single NVIDIA GPU can cost tens of thousands of dollars at enterprise scale. 220,000 of them, plus the cooling, the wiring, and the real estate, which represents a capital commitment that's larger than the annual budget of some nations. Everything was originally built to train Grok, the AI chatbot. Now, through a deal disclosed around the filing, Anthropic has secured access to that same compute for its Claude models. Inevitably, though, Starlink constellation subscription revenue is being converted into NVIDIA compute clusters, which are then leased to outside AI firms. The worker-built internet network funds the infrastructure which powers the enterprise AI automation. The S1 reports that the AI segment generated $818 million in revenue in the first quarter of 2026, which suggests the leasing model is beginning to produce some cash flow. But that $818 million doesn't come close to covering the $7.7 billion in AI capital spending during the same 3 months period. The S1 risk section acknowledges that orbital AI data centers may never become commercially viable. That's quite a legal caveat, which basically says that the company is asking investors, employees, and their customers to fund a bet that its own lawyers admit might not work. The only segment that reliably generates revenue is the one that's built by the manufacturing labor force, whose paychecks now share a financial statements with the Grok's chip bill. The accumulated deficit of $41.3 billion isn't a theoretical number. Basically, it's the sum of every year the company spent more than it earned. Now, the only segment that earns is being asked to cover the division that burns. The S1 simply calls this a growth strategy. An investor who, reading it closely, might consider it a transfer of risk from the consolidated entity to the worker who doesn't really have a choice. And the workers itself aren't just trapped inside the business model because they're also trapped inside the company's stock. The trap consists of 3 layers, and each one is worse than the last. The first trap is the float. SpaceX floated only about 555.6 million shares, which is under 5% of the roughly 13 billion shares outstanding. The remaining 95% sits in insider hands, employee accounts, and locked-up pools. When the stock hit $225 during IPO week, that spike wasn't a proof that the market had revalued the company by 66% in 4 days. It was a tiny amount of tradable stock colliding with enormous demand. The wealth that the employees saw materialize on day one was partly a mirage created by supply scarcity. It was never a stable market verdict after all, because the stock price is supposed to reflect the collective judgment of buyers and sellers. But when there are almost no sellers, the price reflects only the desperation of the buyers. Surprisingly, the S1 warned about this indirectly in its dilution disclosures. It noted that the future sales by insiders could depress the market price, but it didn't quite say that the initial price itself was artificially inflated by the very scarcity those insiders created. The NASDAQ 100 inclusion in early July added another wave of passive buying pressure from index funds, which had to purchase the stock regardless of price. That pushed the price higher just days before the July 15th crash below the IPO price. The second trap is the unlock schedule. Most IPOs use a single 180-day lockup, which was one date with one decision. But SpaceX was doing something else, an 8-date staggered release spread across roughly 6 months. The problem is that each tranche arrives under different price conditions, different news cycles, and a different tax deadlines. It's a scheduling system that maximizes uncertainty for the holder while maximizing tradable supply for the market. And because the shares trickle out instead of arriving all at once, an employee who wants to sell just enough to cover a tax bill can't do it in one clean transaction. They have to guess which of the 8 dates will land at the best price, and most of them will guess wrong. It's happened almost immediately after 70 days around August 21st, which is the first window where you can actually sell anything. But it only cracks open by 7% out of the locked shares. Next one is 2 trading days after SpaceX reports Q2 2020 site earnings, which unlock another 20% shares and a bonus tranche, which was tied to that particular window. Imagine if the stock had traded at $175.50, which is a $135 original IPO price, times by 1.30, which a 30% bonuses trigger. Or maybe higher than that for 5 out of the 10 trading days leading into that report, an extra 10% would have been unlocked. But that was never going to happen because the stock spent the run-up to earnings well below that price, so the bonus simply never had the conditions to get triggered. After that, 4 more window was open for another 7% at day 90, 105, 120, and then 135. But things just kept getting worse after the Q3 2026 earnings report. If you were holding 10,000 shares. Under a normal IPO lockup, you can wait 180 days and make a decision whether to sell all 10,000 or you can keep it. But at SpaceX, you only get 700 shares after day 70, and then 2,000 more after the Q2 earnings report. After that, you only get 700 share each after day 90, 105, 120, and then 135. Finally, after Q3 earnings report, you can get 2,800 shares, but you'll only get the rest of the share on December 8th, which is a standard 180-day mark. That's 8 separate moments where you have to guess whether the price that day is the best they'll ever get or whether you're waiting for the future uncertain price. Unfortunately, the stock fell below $135 on July 15th, 2026, and the remaining balance doesn't free until December 8th, 2026. This staggered dates also mean that even if you want to sell exactly enough to cover taxes, you can't do it all at once, because you must at least guess which one of the tranche that will give you the best price. In doing so, you'll have to be wrong at least 8 times. Meanwhile, the company just keep adding another pressure valve by confirming its first ever bond issuance in late June, which only increased the debt service to the same balance sheet that already carries a $41 billion accumulated deficit. The next trap is consist of its tax system. Restricted stock units get taxed as ordinary income based on the stock's fair market value at the moment they vest, not at the time of sale, not when the worker actually receives the cash, but at vesting. That means an employee whose RSUs vested near the $225 peak already owes a real tax bill calculated on that peak value, but they're contractually locked out of selling at that price because of the staggered lockup rule. If they're forced to sell it later, after the price has fallen below $135 to generate cash for that tax bill, they end up paying taxes on money they never actually going to keep. Let's say you hold 1,500 RSUs that vest when the stock is at $225. So your paper value at vesting is $337,500. But with a 37% federal tax bracket, the tax bill is roughly $124,875. You owes that money to the IRS regardless of whether you can sell those shares or not. Now imagine the lockup prevents you from selling until the price has dropped to $132. If you sell all the 1,500 shares at $132, you receive $198,000, but your tax bill is still $124,875. Therefore, your net proceeds are $73,125. Basically, you paid taxes for $337,500 of income, but you only received $198,000 in cash. The S1 confirms this mechanism in the equity compensation disclosures. Therefore, it isn't a theory. The standard RSU tax treatment applied to a stock with a 9-date lockup and a 40% price collapse. The filing confirms that the IPO created over 4,400 employee paper millionaires on day 1, on paper. As of mid-July 2026, with the stock trading near $126, the number of employees who are still millionaires on paper has dropped sharply. The counter is running backward and the tax bills are still due. Many of those employees may have already received vesting notices at prices above $200. Basically, their tax obligations are fixed, but their ability to pay them was not. They're locked into a schedule they can't really choose, holding to a shares they can't sell, and owing taxes on values that no longer exist. The SPCX NASDAQ listing gave them paper wealth one morning, then locked the door and handed them a tax bill. This is not an error in the system because it's perfectly working exactly as designed. The system that was supposed to launch rockets became the mechanism that launched an AI bet on the backs of the people who built it. That's the story the SpaceX SEC Form S1 tells if you actually read the lines instead of the headlines.